All right, welcome to the daily market recap for Thursday, November 20th. In today's video, I'll be going over the action of the indexes, the liquid leaders, industry ETFs, then end the video with long and short setups going into tomorrow, like I do with every daily recap. If you guys enjoyed the video, please leave a like and subscribe to the channel. And if you want my market takes throughout the trading day, along with the live stream at the open and any trades that I personally take, you can sign up for the Market Pulse Discord using the link in the comment section. We are having a Black Friday sale, so take 25% off your first month or your first year by using the discount code Turkey25. So let's just get into it. A absolutely brutal day in the market. Hopes were high. NVIDIA crushed earnings, both their sales expectations and earnings expectations. Indexes gapped up. NASDAQ was about up 2.2% at one point today. And after the first hour, the crack started forming and we got a massive sell-off. And not just a take some profit sell. This wasn't me and you selling. This was institutions dumping positions at a very high rate. This was the highest volume that we've had the entire move up. And on the downside, we closed under October 10th lows, down 2.4%. And anyone who's arguing that we're still in an uptrend, I don't know what they're talking about. So obviously not a good day on the NASDAQ. Unless you were short, then this was a phenomenal day. Personally, I had a bullish bias coming into the day because we had seen kind of one wave lower, two waves lower, and I was extremely bearish yesterday, like feeling wise, but we weren't making any new lows. So at that point, it's not like I just dumped my entire account on TQQ calls, anything like that. But I felt like a kind of snapback rally was in order, and we had the gap up on NVIDIA's earnings, and we could see what they did to NVIDIA here. They gapped it up into a decline or into a resistance gap, opened on the low of the day, and then just pure selling here. And I did not see this coming because my expectation was over the last 2 weeks, we probably saw a lot of the people that were on the long side kind of liquidate their position through all this distribution. But about an hour and a half after the market opened, we had our NAAIM Active Investors Exposure Index update for the week. Turns out they didn't sell anything. These professional investors during a market correction went from 88% invested to 87% invested. No selling with all that distribution, which is insane to me. Like if you're managing people's money and you see all the growth names start to break down earlier in the cycle, we got that big distribution bar after an acceleration phase on the Nasdaq October 10th. Then you see all the liquidity pile up into the mega cap stocks. Palantir gets their earnings, blows out earnings expectations and gaps down. Then we start to build lower highs and lower lows, and you're still not covering your long positions. That's like, to me, that's malpractice. That's insane. But it makes sense now in hindsight. If everyone's still already long and we get a gap up after all this distribution, we could see something like this, just a pure unwinding of the positions. And one day usually doesn't end that. I did some research on the NAIM numbers, which you can do yourself. Just go to the website, click on here or click here to download the data. And I found two instances where NAIM positioning was over 85%, so elevated but not extreme, over 85%, while the NASDAQ was under the 50-day moving average. Unfortunately, you're not going to like the two scenarios that I found. The first one, NAIM positioning was about 88% back in February 27th of 2025 when the NASDAQ was under the 50-day moving average. That day, we saw a big distribution candle as people liquidated their positions. And that was the start of a correction where we saw a big wave down, bounce back to the declining 200-day moving average, and then the eventual kind of like panic sell off with the tariffs earlier this year. Now, I do want to point out that we didn't get this information and then just go straight down to that level. We actually undercut the previous day's low and then rallied up yesterday into the middle part of that distribution bar. And then the following day, we gapped up even higher into like the top third of that distribution bar before selling off further. So just because like we sold off big today doesn't mean, hey, it's time to start shorting down here. There's going to be a lot of volatility. But this led to another like 20% pullback. Not great action there. And then, unfortunately, the other time within the past 9 years that we had positioning over 85% with the NASDAQ under the 50-day moving average was January 5th, the start of the bear market in 2022. NAIM was at 89%, and we saw groups kind of fall off over time as we built this base. We broke down instead of breaking to the upside, and this kicked off the bear market. Now, I'm not saying that we're going to start a bear market, but this type of action in the indexes do not repair overnight. This type of positioning, still so heavy, does not completely unwind in one bar. Now, if we zoom out, we have the left side of the shoulder ahead. And if we rally back up, similar to what we saw previously, where we rally into the middle part of this big distribution bar, this could be a right shoulder to that head and shoulders pattern. S&P 500 down 1.5%, also takes out October 10th's low on big volume. Obviously, like big extension to the downside. Don't want to just start shorting stuff randomly down here. More likely than not, we get a rally instead of just pure distribution from here. IWO, bearish engulfing candle. Above the 20-day moving average is my risk on or risk off indicator. We've been below the 20-day moving average since November 4th. So there's been really no reason to be long a bunch of names, at least not with a very high position size. So we escape a correction like this virtually unfazed. ARKK, another big distribution bar, bearish engulfing candle, massive volume, giving back all of its gains from almost August 1st. That's why you have to have sell rules, especially in like a risk on, risk off group like ARKK or IWO. Below that 20-day moving average, that's when bad things tend to happen. Then switching over to take a look at Bitcoin, I really thought we were seeing like an undercut and rally 2 days ago. I thought the same yesterday. And today we get further distribution, now trading at 87K, kind of coming back into this previous breakout zone. So we are extremely stretched to the downside. Can we go lower? We absolutely can. But do you want to start shorting stuff like right here as we come back into support? I personally would not. Ethereum also breaking that 3K level, coming back, sitting on a previous breakout spot. Maybe we bounce there. But overall, like this is a clear downtrend. And crypto, another risk on indicator that's just showing us that it's a risk off market. Getting into the liquid leaders, 0 out of 9 of them were up on the day. Obviously, not good action. Eli Lilly, we've seen a lot of money hide out in healthcare and biotech stocks. This is the liquid leader in the healthcare name, in the healthcare group. Inside candle today on lower volume, extreme relative strength. But if this market's going to continue lower, eventually they do come for everything. We don't want to buy it up here, but have some alerts down at the 20-day moving average. If we can pull back into that area, maybe that's a good spot for risk reward. Apple uppercut and failed the resistance gap yesterday, did the same today, losing the 5, the 10, the 20-day moving averages and closing weak. Google made new highs today, then reversed, closed on the low of the day. I wouldn't be surprised if Google is the liquid leader that leads us out of this correction, excuse me, but it's not going to happen overnight, and we don't want to buy it on strength. We want to let this pull back and actually like build out a base first. First Solar was on the watch list. We had this like 4-day pivot, broke through that area, immediately reversed. Whenever you have a pivot in a market that you don't really trust, it's a choppy or downtrending market, and you get a pivot failure, just get out of the trade because more than likely they're using this pivot for liquidity to sell into. And that's what we got, even though First Solar only down 2.4%. The two groups that were holding up the best, two growth groups that were holding up the best coming into today were semiconductors, because they were waiting on NVIDIA's earnings, and the memory stocks. Semiconductor AMD completely smoked today, down 7.3%, below the 50-day moving average, into the support gap and the high volume close. Maybe this is the low. Who knows? We're below the 20-day EMA. So for me, that's a risk off signal. And then the memory stocks, which they held up great. They showed incredible relative strength, just pulling back into their 20-day moving average. Nice tight price action while the market was nice, like wild and loose. So some of these names, if we were going to get an actual bounce, were on my watch list to go higher and to make new highs. But we didn't get the bounce. We got a gap up that because no one had sold the past couple of weeks, that was their opportunity to unload their positions. WDC opened into the resistance gap, immediate reversal, closing down 9% into that support gap. MU, which had bounced at a support gap earlier yesterday and looks honestly kind of nice, um, much smaller gap up to open the day, and then very quick red to green or green to red move, losing the 20-day, and then all the way down to the 20-day or for the 50-day moving average, down 11%. And then SNDK, which had been the leader of the leading theme in the market, nice tight pullback into the 10-day EMA, great relative strength. But this is something that I kind of wanted to call out in this video is if you get like incredible news, but price doesn't respond the same way that you think it would, be very, very cautious if you're long. And if you're short and you're thinking, oh, I'm going to get stopped out of this position, honor your stop. Because if you're not as like hurt by what you would expect with the news, chances are it's going to break to the downside. And that's what we saw with SNDK. If I go to a 5-minute chart, my goodness, this is such distribution. Pre-market, or sorry, post-market yesterday, this was up about 6%, trading into 261 level, like a very sizable rally. Then pre-market, we didn't take out post-market high at any point. And then right when the market opened, we never took out pre-market high. We immediately lost the daily VWAP. We took out pre-market low, and we went green to red. This was the first stock that went green to red on my list. And the fact that it was a leading stock in a leading theme that has been nice and tight, but hadn't gone through any distribution, once it went green to red, that was your sign to say, if you're long, hey, I'm taking profits on this. This is not a good sign for the market. And if you were short, you're like, awesome, this is going to be a big day to the downside. And it was down 20%, closing below the 20-day moving average. Just incredible volume here into that support gap. And then LITE, something that made new highs today, opened on those highs, closed near the lows, back through the 5 and the 10-day moving average. Just lots of weakness there, down 13%. Getting into the industry ETFs, we saw money kind of hide out in XLP, consumer staples, just kind of going sideways. ITB, home builders, which has already been down quite a bit, and was still a distribution day. We opened higher than we closed under the 5-day moving average, but closed flat the last 3 days. It's already been trash. XBI, biotech ETF, has been a leading theme in the market. Uppercut and fail of that resistance gap, close on the low of the day on a pickup in volume. At some point, they come for every theme in the correction. XLV, healthcare ETF, sideways action, but on a big pickup in volume. Usually that shows signs of churning and that resolves to the downside before it can rally. So keep an eye on the 20-day EMA for XLV. And then something that you didn't really want to see was losing financials, XLV, losing the 200-day moving average on a big pickup in volume, rejecting the 20-day EMA on another lower high. Not good for the economy, not good for the market. Other economy stocks, the retail, XRT, losing the 200-day moving average. XLY, consumer discretionary, uppercut and fail, the resistance gap, the 10-day moving average, new closing low, has a date with the 200-day very shortly. PEJ, leisure and entertainment. This is just kind of a head and shoulders breakdown, down 2.4% today. Cybersecurity, down 2.6% into the 200-day moving average. FDN, Internet ETF, losing the 200-day moving average on big volume. IGV, the software ETF, losing the 200-day moving average, down 3% today. Even solar stocks, which like this is their first test of the 50-day moving average since making new highs. It did so on a pickup in volume. If any group is to kind of bounce and put in the low today, I would guess that it would be solar, but um, not something that I'm willing to bet on, especially not with any large position sizing. And then semiconductors, which again had been holding up okay, came in the 50-day moving average, all eyes on NVIDIA. We gapped it over the key moving averages, and then just a massive bearish engulfing candle. Keep an eye on the support gap as a potential bounce spot, but this is a big distribution bar. Rally back up into the 50-day would be a nice short spot. So like I said, like I obviously big picture, I'm very bearish. They took Nvidia with great news, and once again, just like Palantir, they sold that great news. And at this point, there's so many like quality stocks, Spotify, Netflix, Costco, all breaking into stage 4 downtrends. with positioning still heavy on the long side, we're kind of in no man's land. Like the time to short was the last couple weeks, and today, if you had a bearish bias coming into the day, you've probably made a killing today. Great job. Um, but you don't really want to start your shorts right when everyone's giving up, and it feels like we're a day or two away from that. So on the short side, I only have two setups. On the long side, I still don't see any emerging themes in the market that gets me excited. You could play some oversold bounces if you're a short-term trader or a day trader. You love this market, but I don't see any clean bases. I don't see emerging themes. The only theme that we can really cover is healthcare. So we have ISRG. Would not be buying anything on strength. A pullback into either the 20-day at 540 or 538 area, or a pullback into the high volume close from earnings at 530 are the two spots that I would watch for that one. ALB, a chemicals name, nice relative strength recently. Still don't want to buy it on strength. Pullback into a previous low at 108 and the 20-day EMA would be the spot. Maybe worth trying versus the gap zone at 103. Covered. We covered the solar stocks and NXT. Really, just a test of the 50-day moving average. Didn't take out the previous lows, so good sign of relative strength. But if I'm going to enter the stock, I want to see a shakeout of that spot. So support gap, pullback low, shakeout and reclaim 8260. That's the spot that I'd be watching there. MEDP, another healthcare stock, just sideways action. Still don't want to buy it on strength. Look for a shakeout of the pullback lows right around 572 as the potential entry. Then you could use your stop probably at a rising 50-day moving average at that point. TMDX, I still want to keep a very close eye on. It continues to build higher lows, higher lows, higher lows, higher lows. Yesterday, when the market was weak, this was extremely strong, up 14%. And this was only down 7.3% today. Uppercut and failed at the resistance gap. So again, we don't want to buy anything on strength. Watch for a pullback into the gap zone below the key moving averages at this 117 area. That would still be a higher low overall, and then you can manage your risk with a 3 or 4% stop. PARR, an oil and gas name, pulling back into the 20-day EMA in the gap zone at 41.12. That would be the spot that I'd be comfortable trying. This is the leader in the oil and gas theme. So if you were to try one, I think this is the one I'd feel most comfortable trying. I did get stopped out of an oil and gas name today. PBF, I bought it on the undercut and reclaim of the pullback low. Had some nice profit, was profitable today on in the morning, and then got whacked. So even oil and gas names, you're not getting much traction from. ATEC, we have this resistance gap here, so under no circumstance are we buying this on strength. Wait for a shakeout of at least the previous lows here. A pullback into the high volume close from earnings and the 20-day EMA is much more preferred, right around $19, and then you can keep your stop 2 or 3%. Then ESTA, kind of wedging action up here, does have some nice relative strength, but that will get hit at some point. So pullback into the previous lows, $62 would be buyable. Then you can manage your risk against the high volume close and the 20-day EMA and $60 as your stop. On the short side, really only two setups, and they're not A plus at this point. First one, NVIDIA, very similar to the Palantir setup in my mind. This is a late stage base. Palantir was made a massive move from $9 up to $200. Perfect, like incredible earnings, but priced to perfection. So we gap down on earnings. We don't chase the short lower. We wait for a rally up, a lower high, tight price action, and then a day where we see relative weakness. So I shorted this on November 12th. Obviously, it's working out nicely for me. And that's what I'm kind of expecting with NVIDIA. This is a late stage base. We've already moved up thousands and thousands of percent. They've already crushed earnings every single time, but we're selling good earnings. We're liquidating good earnings in this market because we're in a market correction. So we don't want to chase this lower where at the support gap, we've seen bounces like 6 or so times. Let it rally back up into the resistance gap at 190, into the declining 20-day EMA, and let it have a tight day before trying to short the roll back over. And then the other one, Costco, stage 4 downtrend, kind of at the first parts of that. We have the stage 2 uptrend, stage 3 top. We've covered this every single day. lower high, lower high, lower high, lower high. Still don't want to short anything into weakness because this already had quite a snapback from like 874 today to 903. Let it rally back up a little bit more into that 915 area. The 20-day moving average and this previous support area now probably turned resistance. Then you can keep your stop above the 50-day moving average and the resistance gap here. So I'm sure a lot of people had really rough days today. If that is you, don't trade on Friday. Take a step back. You're not going to get all your money back tomorrow. This type of market with this type of volatility, with no emerging themes, with more and more themes breaking to the downside, is only going to frustrate you. At some point, we are going to get a bounce, but we need a bounce, a pullback, a higher low, contraction, and then follow through to the upside before any clean trends can begin. And we also need NAAIM exposure to decline. This can't stay at 86% and we just continue to go higher. This is not going to happen with the distribution in the market right now. So stay patient. If day trading's your market, this is the one that you're going for. But if you're a swing trader, a can slim type growth stock investor, not the time to do anything drastic. Spend your time studying previous market leaders, study previous corrections so you know what to look for before you get involved on the upside. And really, just the market's telling you to take a little vacation, take that break. I hope you guys enjoyed the video. This is the second time I'm recording it because I recorded it without volume first. If you guys enjoyed it, please leave a like and subscribe to the channel. And if you want my market takes throughout the trading day, along with the live stream at the open and any trades that I personally take, you can sign up for the Market Pulse Discord using the link in the comment section. Make sure you use the code TURKEY25 for 25% off either your first month or your first year. Have a great night, and I'll see you guys in tomorrow's video.